On this segment, I would like to focus on a report that we published in Seeking Alpha on October the 10th, entitled Two Aggressive Plays for Bullish Gold. And we take a look at two plays that we feel complement the long-term bullish outlook of the gold market. But on today's segment, I would like to focus on one in particular, which is the XXX Velocity ETF Direction Daily Junior Gold Miners ETF called Jnug. If we take a look at the report that we published last week, the VCPMI indicated that as we come into this week, if the price reaches the levels of 2011, which is the sell 1 level, and 2084, that if you're long coming into this week, that you should use these levels to gradually take profits off the table. And if we take a look at the action so far this week, in using basically the TradeStation platform 15-minute chart for Jnug, we see that yesterday's high completed the first target at 2044. The anticipated move on Friday on sell 1 was 2011. It was activated. The sell 2 level is 2084. This is the daily variable changing price momentum indicator using the same principles as the weekly. And what it does is it gives us an idea of where the daily average price is, and also how we use the extreme above that mean to execute day trades. The same principle is used for the daily, weekly, and monthly reports that we published. And so it appears that the VCPMI, once again, has completed the first target expectation of sell 1 for Jnug at 2011. If we take a look at the intraday, for example, to give you an idea of how we use the intraday as well as the weekly VCPMI indicators, we begin to formulate basically an alignment in price that basically integrates the daily more closer to for day traders. For example, you can apply this incredible trading tool for day trading. using the same principles of the VCPMI, you are able to identify a daily average price. And once that daily average price is identified, we can extrapolate the extreme above that mean. And in using basically the first and the second level of the extreme above the mean, we have a structure that gives us a range of basically, I would say, 1 to 9. And at 9, it's extremely overbought. At 9, the index is basically at the sell 2 level. And the probabilities at that point, using this index, this proprietary index, is between 94% probability that the price, upon reaching these levels, will revert back to its mean or its average price. This took me a long time to understand in using conventional wisdom and using, technical charts, technical analysis that pretty much everybody uses. I could not understand that when the market turns the trend up, particularly, let's say, on a long-term basis, and all the technical analysts grab that signal as a buy signal. What I have experienced as a trader in real-time trading is that the majority of the times the market retraces back. And I could not understand that for a very long time until I understood pretty much the reversion to the mean occurs in every aspect of life. And in using that very same principle, I began to understand that once the price is accomplished, the markets will usually revert back to the mean at least a 50% Fibonacci retracement. Better than 90% of the time. And so, in using these incredible tools like Fibonacci, Fibonacci ratios, Fibonacci retracements, Fibonacci fan lines, Fibonacci support and resistance levels, we have been able to create a proprietary algorithm with a proprietary methodology that we apply for day trading, for swing trading, and for position trading. This tool is able to identify for us the levels of supply and demand, which is what really affects prices in the marketplace. Whether you're day trading, swing trading, or position trading, the price action is always influenced by the buyers and sellers that take place during the intraday session. If there are more buyers than sellers, obviously the price is going to reflect that. And in pointing out to you the different levels here that we are able to use, the VCPMI is not only an incredible algorithm in that it identifies the levels of supply and demand for the following session, whether it be day trading, swing trading, or position trading, but it identifies it with a color. And when the price reaches the B1 level, as you can see here, on yesterday's action, the market tends to revert back to its mean that you see here in green. And the automation of the VCPMI automatically executes the signal without emotion. With better than 90% probability of success in using the principle that most markets, whether you're day trading, swing trading, or position trading, the price will revert back to its equilibrium. Every day, based on its supply and demand, the market price is dictated and will adjust accordingly. If there are more buyers at the opening, the price will put a premium on the opening, and that will be reflected in the price. If there are more sellers that come into play than buyers, that will reflect in the price coming down. What the VCPMI is able to do, in addition to all these functions that I mentioned, is able to tell us, in using the color blue, for example, where it starts to get blue between B1 and B2, it tells us that this area down here is the highest probability that the reversion will occur. And as you can see here, this is exactly what took place from that B1 level around the 1879, and basically the target was completed and automatically executed. What we are able to do basically is to provide for day traders the levels of supply and demand for the following day, the previous day. And you have access to this information by at least before midnight the following day. So it will give you an idea, very good idea, of how to set your structure for the following day. This is one of the great advantages that the VCPMI is able to do for you, is to be able to create a very specific structure of supply and demand for the following day. Not only in identifying the levels of supply and demand, but it tells you exactly the prices to execute and the color to identify those levels. Color is extremely important in the application of the algorithm because it identifies the pivot point, identity, and the level in price in the structure that we follow. And knowing the daily numbers coming in, we also obviously provide the weekly information, and we publish that weekly information in Seeking Alpha for those individuals that are sophisticated traders that know how to manage risk, that trade volatility, that understand what an instrument like Jnug represents when it says 3 times the velocity. You have to be aware that these are very aggressive instruments. But for day traders, swing traders, or position traders that understand volatility is one of the key elements of trading successfully, particularly using the science of mathematics or technical analysis, this is an ideal trading tool that has been able to provide some truly, truly remarkable results, particularly following the price of gold. So, what we have accomplished once again to review this report is that the price of Jnug has accomplished the sell one target of 2011. The market has come down to test the 1871, which is the mean or the average price for the week. And what we saw here was a rally back up to where we currently are trading, which is at 1967. The next target that is activated is 2084 for the remainder of the week. We will continue to give you an update on the recommendations that we feel very, very strong and provide you with this incredible trading tool that you can add to your arsenal of trading tools to be as successful as you can be. It is my pleasure to share this with you and for you to use it in good health and good wealth. Until next time, my friends, be well.